US economic growth accelerated in the third quarter as consumers maintained a strong pace of spending and exports surged. GDP increasing at 2.9%. That's the strongest in 2 years. Signs of economic strength is supportive of an interest rate hike. In fact, the last time US GDP growth surged past 2%, the Federal Reserve raised interest rates. Well, Ian Shepherdson from Pantheon Macroeconomics joins us now. Thanks very much for joining us, Ian. Now, when I say a rate rise, we're talking December, aren't we? Of course, not next week, because we do have the matter of a small presidential election just, 11 days away?
Yeah, there's almost no chance that they're going to do anything next week. It's just, this is a very highly politically charged, very divisive election. The Fed's come under a huge amount of pressure, mostly from the Republican side, but nonetheless, the Fed's not a popular institution right now, and sticking its head above the parapet and raising rates a week before the election, I'd be absolutely amazed.
As I say, that election is just over a week away, but every little bit of data we get really plays not into that, but indeed into what we expect from the FOMC further forward, further into December, January.
Yeah, sure. I mean, I think this number increases the chance that they hike in December. I was pretty convinced they were going to go in December anyway. But at the moment, any beat on a big number, especially GDP, is going to improve the market's perceptions of how likely they are to go. So I think it's not a done deal. Nothing is a done deal. We've seen over and over again how events get in the way. But I think it's about as close to a done deal as we could get, unless something really calamitous happens in the next couple of payroll reports. 2.9 it's a decent headline. I got to say, there's a bunch of quirks in those numbers, including a monumental one-off surge in exports of soybeans, of all things. That won't be repeated in Q4, but the fact is that we're going to be going into that FOMC meeting in December with a decent-looking print on GDP.
Yeah, exports were the standout. The interesting thing, though, on the downside was the consumption and the consumer consumption.
Yeah, we have about two-thirds of the data, or more than two-thirds of the data, before we get the report today. So most people were looking for 2.7, 2.8, and we get 2.1. It doesn't sound like a huge difference, but this is 70% of GDP, so it really does count. What it means either is that the September numbers were horrible, which I think is unlikely, or that they're going to go back and revise down July and August. But unfortunately, we don't find out till Monday when we get the details on those. It does look to me, though, that there's some pretty substantial downward revisions. Having said that, the second quarter consumption number was 4.3. It was huge. It could never be sustained. If you take the average for the 2 quarters together, we're running just over 3, which is fine. In fact, it's more than fine. I'd be quite surprised if it could stay there. So if you're willing to step back a little bit rather than focusing on just 1 quarter's numbers, it looks okay to me.
If we go to comments we've had from Janet Yellen and what we can take from them going into, let's take out next week's FOMC, then the following FOMC, she talked about the concept of running a high-pressure economy. What did you take from that? Because it's been discussed a great deal about what it could mean going forward.
Yeah, a lot of people in the markets take the view that what it means is that we're going to see the Fed allowing inflation to overshoot and not do anything about it. Well, that's yes and no. I mean, if inflation was to rise above the 2% target, but only a little bit, and it was clearly leveling off, or you could plausibly argue that it was going to level off sometime soon, you could then get away with not doing anything about it. The problem for them is that, certainly in terms of the headline inflation rate, it's actually going to be shooting up through the target rather than just creeping up towards it. So the headline PCE target, which is 2%, we're likely to be well through that by the end of the first quarter, just because of base effects in energy prices. Oil prices this time last year were falling, now they're rising, so we're going to see a substantial year-over-year boost, and that's not going to look good. And this is part of the problem for the Fed, that appearances count when they have to go to Congress and explain what they're doing or what they're not doing. And they count as well because inflation expectations, which have been very low and falling for a long time, have helped keep the Fed on the back burner. But those expectations are going to pick up now that energy prices have rebounded somewhat. So I think they're going to have a slightly awkward time of things next year, not because growth is going to be super fast or that actual core inflation is going to be super terrible, but just because the market's idea that they can let it go through the target and not worry about it, I think is going to have some sort of clash with the reality, and actually they will have to do something about it, and rates are probably going to go up more than the market thinks next year.
It would be amiss of me not to mention on-farm payrolls, of course, which is also out next week, but stuck between the Fed and the election, how much credence will the markets be taking from that?
Well, it depends what it says. As always, if it comes in a long way from the consensus, it certainly has the ability to move the markets no matter what else is happening. But based on the survey evidence that we have so far, and it looks to me like it'll be another 150, 175, which is down from the peaks. Unquestionably, we were running well over 200 for a long while. But the pool of people available for work has shrunk. The talent pool is drying up, and that makes it hard to sustain that 200 plus pace. So a 150, a 175, that would be more than enough for the Fed to define a continued improvement in the labour market. That's what they want to see. They haven't set any numerical target for payroll growth or a hard number for the unemployment rate. They've just said they want to see continued further improvement. And I think a 150, a 175 with a decent wages number next week, that's more than enough. We get the same again in early December, and then they hike.
And what does all this mean then for trade, for the markets, for the dollar, for example?
Well, ultimately, I'm quite bullish on the dollar, but more for next year than this year. Most people are now expecting a hike in December, so that's getting pretty much priced in. But for next year, I think the risk is that the Fed has to do more than the markets think, and that's clearly a dollar positive story. But it's a tricky story for equities because it implies a valuation hit from higher interest rates. And of course, for exporters and big industrial companies where they're quite sensitive to the dollar, a strong dollar story, having had a year of a relatively weak dollar, is going to be more pressure on earnings. So it's a more difficult environment coming in for those large exporters, but I think on the domestic side, with a pickup in wage growth making consumers a bit better off, spending will be okay. So it's kind of a two-speed story. I wouldn't want to be an industrial exporter next year if I'm right about how far interest rates have to rise and what that does to the dollar.
On that note, we'll leave it there. Thanks very much, Ian Shepherdson from Pantheon Macroeconomics.